If you are like most of the self-employed persons I come across, you are most likely busy servicing your customers, making sales calls, and running your operation. And bookkeeping is not one of those tasks you are excited about doing. In this video, I want to help you simplify the bookkeeping process by taking you through the 5 simple steps to bookkeeping for solopreneurs. This is because bookkeeping is an integral part of your business. It's a part of your business you cannot do without. And so I want to help make it simpler for you to find it fun in tackling this aspect of your business. My name is zzp'er. I am a bookkeeper here in the Netherlands. I help solopreneurs keep their accounting in order so they can run their business with excitement, clarity, and confidence. But why is bookkeeping important? Bookkeeping is important because it helps you gain insight into the financial health of your business. You need to know where money is coming from and where it is being spent. You also need to be prepared for tax filings. Compliance is also an important element of running a business. And if you own a business in the Netherlands, it is a legal requirement that you maintain a clean bookkeeping system. With a good bookkeeping process, you optimize your taxes. You avoid errors that could lead to penalties and interest. A good bookkeeping process also projects you as a professional business person to the bank, to the lenders, and to external parties. Now that you know why bookkeeping is important for your business, let's get into how to simplify this whole process. Before we get into the 5 steps, first thing first, a bookkeeping process begins with separating your personal finance from your business activities. If you have been following me for a while, you know that this is a theme that I repeat in my videos and in my posts. In order to get a proper bookkeeping process in place, you need to have dedicated bank account for your business where you only have activities and transactions that relate to the operations of your business. So your bookkeeping process all begins with having a separation between your personal finance from your business finance, and this is done by having a dedicated bank account for your business. In this bank account or accounts, only business related transactions are allowed to go through this bank statement. If you want to do anything private, you transfer money from the business account into your personal account and make your private expenditure and expenses from your personal account, and let your business account contain only business activities. This is the fundamental basis for a good bookkeeping process. Now let's get into the 5 steps of bookkeeping. Step number 1 is to gather your source documents. Number 2 is to categorize them in an orderly manner. 3rd is to reconcile your transactions. And 4th is to prepare financial statement from the record you have generated. And the 5th step is to review and analyze your financial statement. Step number 1, gather your source documents. Bookkeeping is all about source documents. A source document is the originating document behind a financial transaction. Think about your receipts, your invoices, and things like that. Every transaction should have a source document. It could also be an email confirmation of the transaction, but every transaction should have a source document. Source documents should ideally contain certain information, such as date, name and address of customer or seller, description of item being sold or service being provided, the quantity, the price excluding VAT, the VAT rate, and the VAT amount. If you are located in the Netherlands, these are important information that needs to be on your source documents. Now it is possible for you not to have the name of the customer on the invoice if you went to a supermarket to buy something, for instance, but that source document will have the name of the supplier, the description of item you bought, the amount, the VAT rate, the date it was bought, so that it can be used for accounting purpose. Ensure that you keep your source documents very well. Every transaction in the bookkeeping process needs to be accompanied with a source document. And this is where a lot of self-employed persons miss it. You do not discard your receipts, and you must keep them for accounting purpose. When you cannot show the receipt or invoice for an expense, it is difficult for the accountant or bookkeeper to recognize that as a business expense. It is a tax requirement to keep your source documents as part of your bookkeeping process. To make this easier, you can make use of accounting softwares. A lot of the accounting softwares like the bookkeeping or Moneybird that I normally use, you can download the app, scan your receipts on the go, and save them directly in the accounting software. Save them in the cloud. Alternatively, you can create a dedicated Google Drive where you save all of this. Whatever the case, ensure that all the transactions that relate to your business, that their receipts and are kept in an orderly manner. Another way you can also make it easier on yourself is buy as much as possible via online. That way you receive your invoices via email. And with an accounting software, you can also forward those invoices directly to your accounting software. It makes it easy to trace all your source documents during the bookkeeping process. Step number 2 is to categorize the financial transactions. It is not enough to gather the source documents. The step after that is to categorize each of these transactions in a specific category in the accounting system. There are 5 major categories that your transactions will likely fall. And we have the revenue, the expense, the asset, the liability, or the equity. These are 5 major categories that every transaction in your bookkeeping would fall under. Revenue. Revenue is the total money you generate from selling your goods or services. So the income you get from your customers, you report them under revenue. Expenses. Expenses are the costs you incur to ensure that your business continues to run smoothly. Think about utilities, transport, telephone, marketing, insurance, and all related expenses that is relevant and necessary to keep your business running smoothly. You report these under expenses. Assets. An asset is a property that you own as a business. You derive long-term benefit from an asset. By long-term, we mean this asset will be used for more than 1 year. In the Netherlands, there is a threshold of 450 euros. So if you buy a piece of equipment and it costs you more than 450 euros, and it is an equipment that can be used for more than 1 year, then you categorize that as an asset. It is no longer an expense. By equipment and assets, we are talking about things like the computer, the laptop, a mobile telephone, or any gadgets that you use for running your business. If it is going to be used for a long period, more than 1 year, and the value is higher than 450 euros, then you classify that as an asset. For assets, the expense you get from owning an asset is depreciation. And again, in the Netherlands, depreciation is usually over 5 years. If you buy a laptop today, then you will depreciate it over 5 years. That means the cost of that laptop, you will spread it over 5 years. It is not going to be an expense in your book in 1 year. Rather, it will be over 5 years. On the other side of an asset is a liability. A liability is the money you owe to third parties. So if you get a loan from bank, it is not an income, it is a liability. If you are using credit card, the balance in that credit card is a liability. You need to report it under liability. Also, think about outstanding tax payments. All of these fall under liabilities. So anything you are owing to a third party is a liability and needs to be categorized under the liability section of your bookkeeping. That brings us to the fifth category, equity. Equity is simply the money you as a business owner have in the business. Under equity, you categorize money transfers between the business owner and the business. It could be money, it could also be transfer of equipment. So anything that belongs to the business owner but is transferred to the business is recorded under equity. If you are sending 5,000 euros from your personal account into your business to support your business, it is not an income. You report that under equity. In the same vein, if you are withdrawing 2,000 euros from your business account into your private bank account, it is not an expense. You treat that as when you are bringing money into the business, it is owner contribution. And when you are withdrawing money out of the business, it is owner's withdrawal. So every financial transaction between the business owner and the business is reported under the equity section. The third step to bookkeeping is reconciliation. By reconciliation, we mean cross-checking every transaction in your bank statement versus transactions in your bookkeeping. So all of these transactions that you have posted and categorized in your bookkeeping, you want to cross-check them against what is on your bank statement or on your credit card or your PayPal or your Stripe account. You want to cross-check and be sure that everything has been recognized in your bookkeeping. Let's say, for instance, the invoice you sent to your customer is 1,600 euros. But when you're doing your reconciliation, you notice that your customer actually paid you 1,500 euros. Then you know something is wrong. It's time to reach out to the customer to find out, why have you short paid me? It could be that the customer has made an honest mistake. Without reconciliation, you will not find that out. Through reconciliation, you may also notice that a certain subscription that you made some time ago is still running and you forgot to cancel. That is the time you will quickly go to that subscription and cancel your subscription. Another importance for reconciliation is you can also notice when something is missing or that a customer is still owing you, have not paid you. That's exactly what reconciliation is all about. That all the invoices you sent out, the money has been received in the bank and it agrees with the invoice you sent out. And that every payment that has left your bank account or your credit card, that they are truly the expenses you expect for your business and that you have also reported them in your accounting. Anything you find missing, you investigate and make corrections in your accounting, or you reach out to the bank for explanation if you find anything that is strange in your bank statement. To make this easier on yourself, it is best to carry out reconciliation on a weekly basis. If this is not possible, make it monthly. Do not delay the reconciliation process, because then you can still remember the activities of the current month. But when you leave it to 6 months down the line, you will find it difficult to remember what happened 6 months back. And you may have also lost your opportunity to canceling a subscription, and it may just run for another 6 months, wasting your money. And if you ever need help from a bookkeeper, it's going to be more expensive when you have things that have not been reconciled over a long time. So try to make this a monthly process. That way you keep things neat and tidy and less cumbersome for yourself. The more frequent you carry out the reconciliation, the easier and faster it becomes for you, and the earlier it is for you to rectify any error, correct mistakes. The fourth step in the bookkeeping process is to prepare the financial statement. After you have categorized all your transactions and done your reconciliations to see that everything has been posted and every transaction has been recognized, it is now time for you to generate your financial statement. This process is super easy if you are using an accounting software. The accounting system will generate a summary of all the financial transactions for the period. There are three main reports that you would normally see, and this is the income statement known as the profit and loss account. You have the balance sheet, and then you have the cash flow statement. The first two are the most important that you need when filing your tax returns: the profit and loss account and the balance sheet. The income statement, i.e. profit and loss account. The income statement shows you how profitable you are as a business. It gives you an overview of where most of your income is coming from, and also lets you see where the bulk of your expenses is going. With this report, you can see what your bottom line is. How much profit have you made over the last 6 months, over the last 1 year, depending on the period you're looking at. The profit and loss account gives you this overview, and you can see how much profit you are making as a business, whether you are meeting the expectation you set for yourself, or you're lagging behind, or you are spending more money than is necessary in certain aspect of the business. You can see this via the income statement. And this is what you need to report your income tax returns. The second report is the balance sheet. And the balance sheet is a list of balances comprising the asset, the liability, and the equity. Initially, I mentioned that we have 5 categories in the bookkeeping process. The profit and loss account has the revenue and the expenses, while the balance sheet has the asset, the liability, and the equity. And generally, asset is equal to liability plus equity. On the balance sheet, you can see how much your business is worth. How much assets do you have when compared to the liabilities and what you're owing to third parties. A healthy situation is where you have more assets than liabilities. So that means that if you need to pay all the debts you are owing today, you have what it takes to meet those obligations. And the owner's equity simply gives you the net worth of that business to the business owner. The cash flow statement, on the other hand, is an extra report that you get from your accounting system. It simply gives you an overview of your cash position. Where is money coming in from? Where is it going out? How much is currently tied outside? How much are you expecting to come in? And it also gives you an overview of whether you are financially healthy. Do you have the cash to continue running your business, or are you likely going to run into cash problems in the short run? In the cash flow statement, you can see this overview in the cash flow statement, and it will help you to maybe reorganize your business. If you are used to sending out invoices after you have delivered your services, you might consider billing in advance, or billing 50% in advance and 50% after completing your services. You want to see that the cash flow is favorable to you, that you continue to have cash to operate your business and not have so much money in the hands of your customers while you're struggling to find money to run the day-to-day operations of your business. The fifth step of the accounting process is review and analysis. Having done all of the step 1, 2, 3, and 4, it is now time to review and analyze the financial statement. What is it telling you? What does the numbers say to you? On the income statement, you can analyze and see your current business operations. What is your profitability? Are you earning enough money to continue to sustain yourself in the business? Do you need to adjust your pricing? Or do you need to cut some costs in order to continue to maximize your profitability? What actions do you need to take? Maybe a certain activity is contributing a lot more money. Meanwhile, you are putting a lot of effort and time into another activity that is not generating much. You might consider switching up things in your operations to commit more time and resources to the other activity that is generating more income, and reducing time and effort on the other activity that is draining your business. The balance sheet, you can see clearly how much you have in the bank. The money you have in the bank, is it your money, or are you owing a lot of money to the tax authority? So let's say you are looking at your balance sheet and you see that your bank balance is 10,000, but you are owing the tax authority 20,000. It means you are owing more money than you have. That means if the tax authority would ask for all their money today, you don't even have it to pay. These are the way you analyze your financial statement, and it will help you adjust the way you run your business. Maybe in the previous period, you were withdrawing a lot of money for personal use and you did not save money for your taxes. Now you look at the financial statement and you see you need to do differently in the future. In the future, you set up a process where you put money aside for tax purpose. These are the kind of analysis you can derive from your balance sheet. You need it also to complete the income tax declaration. Simplify all this process with accounting software. I have mentioned this quite a bit in the course of this video. All of this process can be simplified with the use of accounting software. Of course, you need to know how to use the accounting software. A lot of them have tutorials on YouTube. They have manuals online that will guide you on how to go about it. But you definitely need basic understanding of bookkeeping, which is why I'm making this video. I also have an online bookkeeping course that is self-paced. You can check that out in the description of this video, that provides you more in-depth training on how to go about the bookkeeping process. At the end of the year, most businesses need to produce year-end financial statement because they need it to file their tax returns. If you have been keeping your records in Excel the entire year, it becomes difficult. Using accounting software makes it easier.